podcast, the Rational Reminder podcast. We have an online community. It's community.rationalreminder.ca. It's free for anybody to check out. There's been a big discussion thread on this specifically over the last couple of days that I've been participating in. I don't have strong views on the future of Bitcoin. I think anybody that does have strong views, and this has kind of been my thesis through the online discussion I was just talking about, anybody that does have strong views about the future of Bitcoin is speculating. The best information sources that I've been able to find online explaining why the future of Bitcoin is positive are all based on speculation. So I've said for years, and despite the fact that the price has gone up, sure, in hindsight, I wish I knew the price was going to go up, I would have invested. But my belief has always been and continues to be that future price increases in Bitcoin's value are based on speculation. It's not a productive asset. Stocks are productive assets. You're buying, like we've talked about through this session, you're buying the underlying cash flows of real businesses. With Bitcoin, you're buying something in the hopes that somebody else will buy it from you for more later. And that just doesn't sit well with me. I've been wrong, if we define wrong as the fact that I never said the price wouldn't go up. But like I said before, it would have been great if I knew what was going to happen. I don't invest in cryptocurrencies at all. I have no intention to do so. I don't think that an increase in the price of an asset is a reason to invest in it. You could argue it's a reason not to invest in it, although with Bitcoin, I wouldn't go that far because I have no idea what the expected future outcome is going to look like. I think it's full of randomness. Any prediction is pure speculation. So that's kind of my stance on it. And when we don't at our firm allocate to cryptocurrencies at all, and don't have any intention of doing so. I love the question. You don't have to understand everything. To be a good investor, if you can take it on faith, and this is a big ask, I guess, if you can take it on faith that everything that I've just said to you in this session is true, that the market's pretty much efficient, at least efficient enough that you shouldn't try and outguess it. The most important things are diversification and minimizing your investment costs, all that kind of stuff. If you can believe all of that and buy low-cost index funds and stick with them and keep your head down and save appropriately and all that kind of stuff, you don't really need to know anything. But I think that doing that action of doing nothing, almost paradoxically, is one of the hardest things to do in investing. One of the things that's going on right now, we just had this thing with a company called GameStop, where a bunch of people were speculating on the price due to some underlying financial market structure constraints that were in place at the time. And the price did go up a lot. It's since come back down. A lot of people lost a lot of money investing in that. Stuff like that happens all the time. The previous question mentioned the ARK investment funds. This is a family of funds, of actively managed funds that have done exceptionally well recently. Exceptionally well. Investing in companies like Tesla and a bunch of other tech-related, innovation-related companies. Not investing in ARK or Bitcoin or whatever's done well recently is one of the hardest parts of investing. So if you can understand that that's not a good idea to chase performance, then you can be perfectly fine. If you end up hiring a financial advisor, I think having the baseline understanding that if a financial advisor is not telling you to invest in low-cost index funds, it's either a red flag or they better have a very, very good evidence-based explanation for why they're telling you to do that. There's other stuff too, like in a lot of cases, a financial advisor, especially with physicians, might try and sell you permanent life insurance. Again, that's a tricky one. So what's the minimum level of knowledge that you need to have? I guess I would almost punt the question and say skepticism. If you're working with a financial advisor, over time you may build trust. I'd like to think that I have trusting relationships with clients. If you don't have that trust, skepticism is extremely important, because there are a lot of different things that someone can sell you, especially when they're in a position of authority like that, it's possible to make them sound really good. But just asking questions, being skeptical of anything that isn't a low-cost index fund, not to say that there aren't other things that you should be looking at, but healthy skepticism around anything that is not a low-cost index fund, I think, is probably the most important skill, if we can call it that, to take to any relationship with a financial advisor. So one of the most important questions to ask any financial advisor is, how are you paid? How do you get compensated? If someone is earning their living off of commissions by selling you products, I think that's about the biggest red flag that you can possibly have. So I think that's probably it. Maybe, and this kind of is a different way of saying what I just said. But any financial advisor that tries to convince you that index funds don't make sense, and there's all sorts of arguments out there that I've had to combat over the years. Anybody that tries to sell you on that idea, index funds don't make sense, and therefore you should invest in this other thing that I am able to sell you, that's a big red flag. But the single biggest red flag, though, is the compensation piece. How do you get paid? And if it's, well, I sell you this product and the company that I sold the product from pays me, yeah, I'd be pretty uncomfortable with that arrangement. Yeah, it's a great question. This comes up, doesn't come up with clients because they understand what I'm about to tell you, but it does come up on my YouTube channel quite a bit. I am a portfolio manager. I do manage money for clients, but I do that using low-cost index funds. I'm not an active manager. At PW Capital, we don't pick stocks. We don't pick funds. Well, I guess we sort of do, but we use low-cost index portfolios to invest our clients' money. So when you're dealing with a financial advisor, the portfolio is one of the smallest components of the relationship. We often say at PWL that investing's been solved. Like I just talked about a whole bunch of the evidence. We kind of know. We can't predict the future, but we kind of know in broad terms what makes sense in terms of how to approach investing. So that piece, I like to say, has been solved. I mean, you can get like the asset allocation ETFs that I mentioned at the end of my session there. You can get those for a very low cost, and you can get that embedded portfolio advice just by buying a product. You don't need a financial advisor for that. I think where having a relationship with someone that does my job becomes valuable is in making bigger picture financial decisions. So I kind of brushed over the idea of having a corporation. Once you have a corporation, there are a whole bunch of tax planning and investment related decisions that you have to make, and not just once, that you're making all of the time. Likewise, as your overall level of assets increase, there again becomes more decisions that you have to make. Even things like asset allocation over time. What should your mix between stocks and bonds be? Should you use leverage, and how does that change over time? Those are decisions that happen not just once. It's not a static solution. And then other stuff, like I mentioned, permanent insurance, you probably don't want that. But in some cases, when someone has a corporation, that is a product that can make sense. So having someone that you trust to help to run the numbers on that, and other insurance products like annuities, which again, they get a bit of a bad reputation. In some very specific cases for retirement planning, they make a lot of sense. Anyway, I'd generalize that piece as product allocation. So that's another thing that having a relationship with a financial advisor can help with. And then even more basic stuff, like how much do you need to be saving to meet a retirement goal? So when I think about my day-to-day job as a portfolio manager, that's what it's focused on. It's very little focused on implementing the portfolios, because we kind of have that piece solved and automated. It's much more focused on bigger picture decision making with a client. So that's why I still have a job despite advocating for index funds. Yeah. So optimizing the location of assets once they're in the account. So which asset classes do you hold in which type of account? It's actually a really complicated question. And the reason it's really complicated is that the RRSP specifically, you don't own all of the asset. You only own the after-tax portion of it. So remember I said that what goes into the RRSP is pre-tax money. Eventually you're going to pay tax on that. So to do asset allocation planning, you have to think about the RRSP on an after-tax basis. You have to net out the amount of future tax that you expect to pay on that account. Now this gets really confusing because when you look at your accounts, you see the pre-tax amount in the RRSP. This led for many years a lot of people to believe that putting all of your bonds in your RRSP led to a better expected outcome. Now, when you go and put this in a spreadsheet and run the numbers, it's true. If you compare two portfolios with the same pre-tax asset allocation, but one has all of the bonds in the RRSP, that portfolio is going to do better in a simulation or in a spreadsheet. But the reason, and this is where it gets really tricky, the reason is not that bonds are more tax efficient in the RRSP. The reason is that by putting your bonds in your RRSP, you reduce your exposure to fixed income. You make your portfolio more aggressive. So if you compare a more aggressive portfolio to a less aggressive portfolio, of course the more aggressive one is going to look better. But it's not because it's more tax efficient. So optimizing for tax efficiency, after taking into account all of that stuff, the pre and after tax asset allocations, it doesn't add a ton of value in terms of cost savings. Where it can add some value is when you start getting into using US listed ETFs inside of the RRSP account. They can be more tax efficient for certain asset classes than a Canadian listed ETF. So those types of optimizations can start to add a more meaningful amount of value. The way that we think about this, just because of the added complexity of trying to optimize it and the questionable value added from doing so, we keep the same asset mix in all types of accounts. So SPACs are not new, but the interest in them is new. Last year was the biggest year for SPACs in history. A SPAC is a special purpose acquisition company. So this is it's a situation where an IPO happens, an initial public offering happens for a company that isn't actually a business. So it's called a blank check company. So it raises money on the promise that it's going to find an operating business to invest in. So if you invest in the IPO of a SPAC, you're investing in the potential for that special purpose acquisition company to invest your money in a private operating business and take that company public. Historically, we actually just recorded for the Rational Reminder podcast, we recorded an episode with a guy named Jay Ritter. He's known as Mr. IPO. He's the world leading expert on IPOs, including SPACs. So this data is in my head from that conversation. Historically, the returns on SPACs for investors at the IPO have been very attractive. They have truly earned high returns. And because of the structure of the SPAC, it's actually less risky as well. Now, what's happened recently because of all the interest in SPACs is that after the IPO, after the SPAC raises money, the prices have been jumping up. So if you try and go and invest in a SPAC on the secondary market, the price is already going to be inflated to reflect the potential appreciation if they acquire an operating company. So what Professor Ritter explained to us is that the expectation of earning the historical returns on SPACs going forward is probably not reasonable just because the prices are jumping up now. So I don't think that SPACs are any kind of silver bullet. I think it's an interesting additional avenue that companies can use to go public, but I don't think it's an automatic or obvious way to earn excess returns, at least not now that the prices have started jumping up based on speculation. The question with outperformance is never about the information that we know. Everybody knows that Elon Musk is tremendously creative and aggressive with pursuing his ideas, which is amazing. And look at what he's been able to do. Some pretty cool stuff. But stock returns don't come from greatness. So forget about Elon Musk, forget about creativity. Let's just say a fantastic company. or keep with creativity, because that was a question. So a company driven by an enormously creative founder, their creativity is already included in the share value of the company. For the company to perform better than you would expect it to based on its riskiness in the future, so like Tesla's had these enormous unexpected returns, for that to happen going forward with any company, if we use creativity as the metric, the fruits of the creativity, the realized fruits of the creativity have to be better than what the market expected at a point in time. So as of today, using Tesla as the example, the price has gone through the roof, skyrocketed, largely or possibly related anyway to Elon Musk's creativity. For the next 5 years, or for the next year, or whatever it may be, for the price to continue skyrocketing the way that it has, people are going to have to continuously realize that Elon Musk's creativity is better than they currently believed it to be. The price now reflects current beliefs about his creativity and what that creativity can do for the company. For the stock to have high unexpected returns, we expect stocks to earn positive returns regardless. But the big, huge returns that Tesla's seen, those are unexpectedly high. That's higher than you would expect from the market as a whole, for example. That I don't think is reasonable. And it's the same kind of thing with a lot of the companies that are in the ARK ETFs that were mentioned in the first question. These are all companies that are doing innovative things, and the market believes that they're going to be great businesses. That's why their prices are high. That's why they've been successful recently. For the outsized returns that have happened in the recent past to continue in the future, all of those companies are going to have to continue surprising the market with how innovative and creative and profitable they actually are.